This is the second video in a multi-part series on subpart of income. In this video, I'll discuss the various exceptions whereby certain activities that would otherwise constitute foreign personal holding company income are accepted because they meet additional criteria laid out in the rules and the regulations. As a recap, foreign personal holding company income is one of three categories of foreign-based company income that may give rise to Subpart F. Foreign personal holding company income relates to certain passive type activities, such as dividends, interest, rents, and royalties. The four exceptions that limit the inclusion of some passive income into the U.S. as Subpart F are the same country exception, active trade or business exception, the active financing exception, and CFC look-through rules, which are a temporary provision that get extended from time to time. In this video, I'll dive into each type of the exceptions with the examples. The first exception is the same country exception. It applies to dividends, interest, income, rents, and royalties received from a related corporation. A related corporation means a corporation that controls or is controlled by the CFC, or a corporation that is controlled by the same person or persons who control the CFC. Remember, Sub-F applies only to U.S. persons who own a CFC, which is why we look to the CFC provisions. Control is defined to be the direct or indirect ownership of stock possessing more than 50% of the combined voting power or value of the CFC stock. Let's assume we have a U.S. shareholder that wholly owns CFC-A. CFC-A owns 60% of CFC-B. A U.S. shareholder also owns 80% of CFC-C. CFC-A and B are related because B is controlled by A. CFC-A and C are also related because they are both controlled by the same person, our U.S. shareholder. Finally, in order to qualify for this exception, the related parties must be created or organized in the same country. The related corporation's activities must be substantially in that same country, or at least 50% of its business assets should be in that country of the CFC to fall under this rule. Continuing on with our example, let's assume CFC-A and C are in country Y. CFC-B is in country X. We already confirmed the CFCs are related. Therefore, a dividend, interest, royalty, or rent payment from CFC-B to A would not qualify for the same country exception. However, a dividend, interest, royalty, or rent payment from CFC-C to CFC-A or CFC-A to CFC-C would meet this exception and not be considered foreign personal holding company income by the recipient CFC. They're in the same country. For rents and royalties, it is important to confirm the income was for use of or the privilege of using property in the same country. And for dividends, it's important to also confirm the dividend is paid out of accumulated earnings that were earned during the time the CFC was related and that CFC was in the same country. One quick additional consideration is whether to check the box on a CFC with respect to this exception. This can change whether the exception does or doesn't apply. For example, if CFC-B is checked, there is no longer a payment from one CFC to another, as CFC-B is not a CFC, but instead a disregarded branch. Furthermore, if B made a payment to C, it would actually, from a U.S. perspective, be seen as A making the payment to C, which changes how we look at this transaction. The second exception we're going to talk about is the active trade or business exception. The active trade or business exception applies only to rent and royalty payments received by a CFC. Additionally, only payments received from unrelated parties qualify, whereas in our prior exception, it was related payments. The third requirement for this exception is that the CFC derives such income as a result of actively conducting a trade or business. Let's assume, again, we have a U.S. shareholder that wholly owns CFC-A in country Y. CFC-A receives rental income from an unrelated party also in country Y. The CFC is deemed to actively conduct leasing business, in this case qualifying for the exception, as long as its own staff and employees either leases the personal property that it regularly manufactures or produces, or if it acquired the property, has added substantial value to it. In the case of realty, the CFC regularly performs active and substantial management and operational functions during the lease period. If the lease is the result of marketing functions and the marketing organization that performs such functions is organized in the same country and the activities are performed by the staff of the CFC, they meet this exception. Finally, there's a 10% safe harbor for rents derived from leasing an aircraft or vessel in foreign commerce. Let's instead now assume that same payment is a royalty payment and not a rental payment. Royalties are considered derived in the active conduct of a trade or business if CFC licenses property that it developed, it created it, or produced it. Similar to leasing income, royalty income that is a result of marketing functions and the marketing organization that performs such functions is organized in the same country and the activities are performed by the staff of the CFC are also accepted. So you're making sure that the CFC is involved in the actual business that resulted in the receipt of the rental payments or the royalty payments in this case. The third exception we're going to discuss is the active financing exception. The active financing exception is met when an eligible CFC receives qualified banking or financing income. Let's start by understanding when a CFC is deemed eligible. Then we will better define what it means to earn qualified banking and financing income. An eligible CFC is a CFC predominantly engaged in the active conduct of a banking, financing, or similar business. In other words, substantially all of its income relates to financing activity. The regulations define this to be either more than 70% of the gross income of the CFC is derived directly from the active and regular conduct of a lending or finance business from transactions with customers that are not related persons. So not related is very important. Or the CFC is engaged in the active conduct of a banking business and is an institution licensed to do business as a bank in the U.S. Or the CFC is engaged in the active conduct of a securities business and is registered as a securities broker or dealer. In order for the income to be considered qualified banking or financing income, the CFC must receive the income from customers outside the U.S. and it must conduct substantially all of its activities in its home country. And the home country must treat the income as earned by the CFC in that country for U.S. tax purposes. So all of this must be met to meet the active financing exception. The fourth and final exception is the CFC look-through exception. This exception has similar requirements to the same country exception in that it applies to dividends, interest, rents, and royalties received from a related person. However, in this instance, the country of payer does not matter, only that the payer is a CFC. When payments are made, the recipient CFC essentially looks through to the underlying activities of the payer to determine whether or not the income is Subpart F. Let's do an example to better illustrate. Assume a U.S. shareholder wholly owns CFC A. CFC A owns 100% of CFC B, and CFC B owns 100% of CFC C. All entities are new this year, so their E&P generated will come only from current year earnings. Let's also assume CFC C earned $300 of book income during the year all through its business activities, and none of it is Subpart F income. CFC B, on the other hand, before receiving any related party payments, receives $100 of book of income from sales within its own country. If CFC C pays interest of $100 in the year to CFC B, because CFC C has no Subpart F, the income that is paid up to CFCB is when it's received, all interest income will not be Sub-F. It'll be excluded from foreign personal holding company income under this exception. In other words, CFCB will now have $200 of E&P, of which is not Sub-F. Let's say then CFCB makes a dividend payment of $200 up to CFCA. This dividend income received by A will keep its designation. We look through to B's characterization of the earnings. CFC will get to treat the dividend from B as non-Subpart F income. If, on the other hand, CFCB did have some Sub-F income, a proportion of the dividend received by A would be Sub-F and a portion would not. There are some exceptions to this exception. This exception does not apply if the payment made reduces the payer's Subpart F income or effectively connected income, or payment creates or increases an E&P deficit of the payer or another CFC, and thus also reduces Sub-F. There is also an anti-abuse notice that limits the use of this exception if it impacts other U.S. inclusions, such as 956 or factory net income. In other words, you cannot make a payment from one CFC to another as a way to avoid Sub-F by the payer. If that happens, going through the rules and the mechanics, then it will no longer be considered non-Subpart F and it will be picked up, at least at the recipient level, as Subpart F income. Furthermore, if a dividend payment is being evaluated for this exception, there are a few additional items that may result in it being ineligible for this exception, for part of it or all of it. That is, if it is paid out of E&P associated with an extraordinary disposition account or an extraordinary reduction amount, all of those occurring as parts of the Tax Cuts and Jobs Act legislation. Now that we discussed the 4 exceptions, let's recap our review. U.S. persons of CFCs may include as Subpart F income foreign-based company income, which is comprised of 3 types of income: foreign personal holding company income, foreign-based company sales income, and foreign-based company services income, the rules and general definition of which are explained in video 1. This video walks through how passive income that otherwise may be foreign personal holding company income can be accepted if any one of the 4 exceptions we discussed are met. In the next video, I'll discuss the exception to foreign-based company sales income. To get further notifications regarding the release of new videos or to provide some comments regarding other videos you would like presented, please subscribe to my channel below.